Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
It's great to be here. We have a really substantial file on the desk today. I mean, we are looking at a company that sits right at this fascinating intersection of legacy government bureaucracy and the absolute bleeding edge of modern warfare technology.
We are turning our attention to CACI International. The ticker symbol for those following along is CACI.
CACI.
Now, for those of you who track the defense sector, CACI is a, familiar name. But the whole mission of our coverage today is to really challenge the standard perception of this company.
Absolutely.
Most people, and I'm talking even seasoned investors, they look at CACI and see a standard government services contractor. Basically, they see a high-end temp agency for the Pentagon.
And that's been the reputation for decades, right? It's not an unfair assessment of their history. But the source material we're analyzing today, I'm talking specifically about the first quarter fiscal year 2026 earnings, the recent acquisition filings, all the analyst notes. It just tells a completely different story.
A different story, how?
There's a massive identity crisis happening here, but in the most profitable way possible.
Right. So the core debate we need to try and settle over the course of this analysis is pretty simple. Is CACI still just a stable, maybe somewhat boring government service provider? Or is it actually a high-growth technology play that is, for now, disguised in camouflage?
And we have to answer that question while looking at a very chaotic backdrop. You have a new administration in Washington. You've got the Department of Government Efficiency, or DOGE as it's being called, threatening to slash budgets across the board.
And on top of that, a geopolitical landscape that is, I think it's fair to say, more volatile than it has been in years.
To say the least.
Okay, so let's set the stage a little more before we get into the weeds of the financial statements. CACI was founded in 1962.
The same year as the Cuban Missile Crisis.
Which feels incredibly relevant right now, doesn't it?
It really does. History rhyming.
They're headquartered in Reston, Virginia, which is really the beating heart of the defense establishment. Currently, they are trading around $611 a share. So that's as of January 2026.
And it's sitting right near a 52-week high.
It is. Market cap is roughly $13.5 billion.
So to place them in the ecosystem for you, they're not a small player by any means, but they are certainly not a massive prime contractor like a Lockheed Martin or a Northrop Grumman. They occupy this really interesting middle ground. They're too big to be ignored, but, and I think this is key, they're small enough to be agile.
Exactly. Now, I want to start with the financials, specifically from the first quarter of fiscal year 2026. Because, so often when companies talk about transforming or pivoting, it's just marketing fluff.
It's slide deck.
It's a slide deck with cool graphics, but no substance. But the numbers here, they seem to actually back it up.
They absolutely do. If you're an investor out there and you're worried about this new Department of Government Efficiency slashing spending, these numbers offer a very, very strong counter-narrative. The growth is real, and it seems to be accelerating.
So let's look at the top line first. Revenue. It came in at $2.29 billion for the quarter,
which is up 11.2% year over year.
That feels pretty strong for this sector.
It is. And to put that in context for you, they beat the consensus estimates by about $40 million. Now, in the tech world, a $40 million beat might seem like, a rounding error.
Right.
But in the world of government contracting, that is a significant beat. Usually these contracts are fixed. You know almost exactly what is coming in the door. So a beat of that magnitude suggests they are either winning new business faster than anyone expected, or
they're just executing on their existing work much more efficiently than the analysts thought was possible.
Precisely. It sets a tone of outperformance right from the jump.
But I think the bottom line is where the story gets really, really interesting. The adjusted diluted earnings per share, the EPS, that came in at $6.85.
Up 15.5% from last year.
Huge jump.
And they beat the street consensus by 70 cents per share. I mean, $0.70. That's a massive divergence from expectations.
So what drove that? Was it just, simple cost cutting? Did they just fire a bunch of middle managers to make the number?
No, and this is absolutely key to the whole thesis. It was margin expansion. Their EBITDA margins, that's earnings before interest, taxes, depreciation, and amortization, they expanded by 120 basis points.
To 11.7%.
To 11.7%.
Okay, let's pause right there, because for the generalist investor tuning in, a 1.2% increase, 120 basis points. It doesn't sound like earth-shattering news. Why is that such a big deal in this specific sector?
You have to understand the mechanics of the business model. In traditional government services, that renting out bodies model we mentioned earlier, the margins are razor thin. You're usually fighting for maybe 7%, 8% margins because the government strictly caps how much profit you can make on direct labor costs. It's a game of pinches. You make your money on sheer volume, not on the markup.
So seeing margins push up not just to 10%, but heading toward 12%?
It signals a fundamental shift in what they are selling. You just generally do not get 12% margins by selling hours of labor. You get those kinds of margins by selling technology, intellectual property, finished products.
Oh.
It's the first really tangible proof in the financial statements that they are moving up the value chain. They're getting paid for the value they create, not just for the time they bill.
That leads us perfectly into the metric that I honestly thought was a typo when I first read the report. We need to talk about free cash flow.
The lifeblood of any business.
It is. I mean, earnings can be manipulated with accounting tricks. We all know that.
Cash flow's truth.
Cash flow is truth. And CCIs. It rose 189% year over year.
189% to $143 million.
It nearly tripled. How does a company this mature, this established, suddenly triple its free cash flow in a single quarter?
It's a combination of really impressive operational discipline and that shift in contract mix we were just discussing. So first, they are getting much, much better at the cash conversion cycle.
Which is just fancy Wall Street talk for getting the government to pay its bill faster.
Right. Precisely. They're invoicing faster, they're processing the immense paperwork faster, and they're collecting the cash faster.
Yeah.
But I think the primary driver here reflects the nature of selling technology products.
How so?
Well, think about it. When you sell a piece of software or a hardware system, the cash dynamics are often superior to a service contract. In services, you have payroll going out the door every 2 weeks. That's cash out. But you might have to wait 60, even 90 days for the government to reimburse you.
A huge float.
A huge float. With products, the payment milestones can be much more favorable. You get paid upon delivery or upon hitting certain milestones. It just aligns the cash in and cash out much better.
And management isn't being shy about this. They are forecasting the full fiscal year 2026 free cash flow to be at least $710 million.
At least.
That would be 16% growth for the full year on top of this massive quarter.
And that $710 million number is the number that you as an investor need to circle in red ink. That is their war chest. That's the capital they can use to pay down debt, to buy back shares, or as we've seen very recently, to go on an aggressive acquisition spree.
It gives them optionality.
It gives them complete optionality. When you have that much cash coming in the door, you control your own destiny regardless of what the Fed is doing with interest rates.
We are absolutely going to get to that acquisition spree in a moment because it is substantial. But before we do, I want to address the safety net. Because if I'm listening to this and I hear about budget cuts, political chaos, efficiency departments, I'm naturally worried about revenue just falling off a cliff.
It's a totally valid fear. If the government stops spending, usually these companies starve. It's that simple. But CACI has built what I can only describe as a fortress around their revenue stream.
The backlog.
The backlog. Their total backlog now stands at a record $34 billion.
Billion with a B.
With a B. And that's up 5% year over year.
34 billion. I mean, to put that in perspective for you, based on their current revenue run rate, that is roughly 4 years of work.
Exactly. If the entire sales team took a 4-year vacation starting tomorrow, the company would still have work to do. It's just incredible visibility into the future.
And even more specifically, the funded backlog, which is the key number.
The really important one.
This means the money has actually been authorized by Congress and is sitting in an account waiting for them. That number increased 26% to $5.4 billion.
And that's the sleep well at night number. Even if the government shuts down next week or if there's a continuing resolution that freezes all new contract awards, CACI has $5.4 billion of funded orders ready to execute.
It insulates them.
It completely insulates them from the immediate day-to-day chaos in D.C. It buys them time to adjust their strategy while other, less prepared companies might be scrambling for cash.
Okay, so we've established the financials are robust. But you mentioned that the margin expansion signals a change in what they're selling. Let's dig into the business structure. They divide the company into 2 pillars.
Right. And historically, CACI was what they call an expertise company.
Which brings us back to that staffing agency for spies concept.
A very sophisticated staffing agency, yes, but that's the gist of it. This segment brought in $986 million this quarter, and it involves providing talent, software developers, naval architects, intelligence analysts, to sit inside government agencies and help them run their operations.
And it's mostly a cost-plus model.
Mostly, yes. The government pays the employee's salary plus a fixed fee for overhead and profit. It's very low risk, but is also very low reward.
Why low reward?
You can't really scale it exponentially.
Yeah.
To double your revenue, you generally have to double your headcount. And hiring people with top secret security clearances is incredibly difficult and incredibly slow. There's a natural ceiling on that growth.
But then we have the second pillar, technology.
This is the growth engine. This is the whole story. This segment brought in $1.3 billion this quarter.
So it's bigger.
Notice that, yes, the technology segment is now significantly larger than the expertise segment. That's a huge milestone.
So just statistically speaking, they are now officially more of a tech company than a staffing company.
That is the crossover point we've all been watching for. Approximately 57% of their revenue is now coming from technology. And this segment is growing much, much faster, up around 22% in some of the recent metrics.
And this is where they sell things like...
This is where they sell proprietary tech, electronic warfare systems, artificial intelligence platforms, autonics, things they have built, they own, and they can sell over and over again.
And this directly explains the margin jump.
Exactly. If I rent you a naval architect for a year, I can only charge a small markup on their salary. But if I sell you a proprietary anti-drone system that I developed myself and I own the patent for, I can charge a significant premium for that value.
It's the classic services versus product debate.
It is. CACI is moving from renting out time to selling finished capabilities. And the market, as we know, pays a much higher multiple for product companies than it does for service companies.
I want to zoom in on one specific finished capability that really stood out in the Barron's report and the earnings call transcript. Electronic warfare and counter-UAS.
Counter-unmanned aircraft systems.
Oh.
In other words, drone defense. This is probably the most critical tactical problem on the modern battlefield today, bar none.
And the CEO, John Mengucci, he used some language that you just rarely hear in a corporate earnings call. He didn't just say the product works. He said their systems are, and I'm quoting here, battle-hardened with hundreds of confirmed kills.
It is a very striking statement. CEOs usually prefer these, corporate euphemisms like operational success or successful field deployment. To explicitly say confirmed kills tells the market two things. One, this is not a prototype sitting in a lab somewhere. It is in the field, likely in active conflict zones like the Middle East or Eastern Europe. And two, it works. It is actively saving lives and destroying threats right now.
The specific product he's referring to is called Merlin.
Yeah.
Can you explain, in simple terms, why Merlin is so different from just, trying to shoot a drone down with a missile?
Okay, so the problem with drones, especially the small, cheap plastic ones you see in modern conflicts, is that traditional radar struggles to see them. Radar is designed to find big metal objects, fighter jets, missiles, ships.
So a small plastic drone to a traditional radar, it just looks like a bird.
Exactly. It gets lost in the background noise, or what radar operators call clutter. If you turn up the sensitivity to find the drone, your screen just gets flooded with thousands of birds, weather patterns, and you can't target anything.
It's useless.
It's useless. Merlin takes a completely different approach. Instead of just looking for the physical object, it listens for the signal. It detects the radio frequency, the RF link, that the drone is using to communicate with its operator.
So it hears the drone before it ever sees it.
That is the perfect way to put it. It detects the drone's electronic fingerprint. And once you have that signal, you have options. You can jam it, you can take control of it and fly it home, or you can direct a kinetic weapon, like a laser or a gun, to shoot it down with pinpoint accuracy.
It creates a layered defense.
A layered defense. But the brilliance is in that initial detection. You simply cannot hide your radio signal if you want to fly the drone.
Mengucci mentioned this is a multiples of billions market opportunity.
The estimates are just huge. The entire electronic warfare market is estimated at around $150 billion. The total addressable market for CCI within that is closer to $280 billion when you factor in all their capabilities.
And the drone part specifically.
The counter-drone market specifically is expected to grow at a 25% compound annual growth rate.
25% CAGR. That is tech startup levels of growth. That's not what you expect from a defense contractor.
It's not. And importantly, it's not just the Department of Defense buying this anymore. The Department of Homeland Security is now a huge customer. Think about airports, football stadiums, nuclear power plants, government buildings.
They all need to be protected.
They all need protection from drones.
Right.
It is a pervasive domestic threat now, and CACI has positioned itself as the solution provider that is available now, not 5 years from now after a long development cycle.
That availability is a key theme we'll definitely return to when we discuss the political changes.
Yeah.
But first, we have to talk about how they are fueling this transformation. They aren't just building all this amazing tech in-house from scratch.
No, they're not. They've been on a very aggressive, a very strategic acquisition spree. They are using that balance sheet and that free cash flow we talked about to buy capability gaps.
Let's look at the two big recent ones. First, there was Azure Summit Technology. They picked that up for about $1.3 billion.
Azure Summit specializes in radio frequency RF technology and electromagnetics. This fits perfectly, perfectly, with the Merlin narrative we just discussed.
To the bolt-on.
It's a perfect bolt-on. If you want to win the drone war, you have to dominate the RF spectrum. Azure Summit gives them some of the best minds and best tech in the world for doing just that. It strengthens their core offering.
But the really big news, the monster deal that dropped in December of 2025. The acquisition of the RRKA Group.
This was a massive swing for the fences, $2.6 billion, all cash.
All cash in this interest rate environment. That is a very confident move.
That is statement.
So what did they get for $2.6 billion?
They bought a leader in the space domain. RRKA specializes in space-based sensors, sense-making, which is a great industry term for processing complex data from multiple sources, and optical technology.
I was surprised by this one, because I've always thought of CACI as more of a ground-enabled support company. Why go to space? Is this just about the Space Force?
It is about the Space Force, but more broadly, it's because that is where the future of warfare is going. It's about what the military calls multi-domain operations. You need sensors in space talking to assets on the ground, in the air, and at sea, all in real time.
So by acquiring RKA, CCI can connect their existing ground and air capabilities with these new space assets.
Exactly. They can now offer a complete sensor-to-shooter loop.
Okay, explain sensor-to-shooter for listener who might not be in the military. Why is that loop so incredibly valuable?
Sure. So in the old days, a satellite might see something, let's say a formation of enemy tanks. It takes an image, sends it down to a headquarters on the ground. An intelligence analyst looks at it, types up a report, picks up a phone, and calls a field commander. That commander then radios a pilot to go attack the target.
A lot of steps.
A lot of steps, and it takes time minutes, sometimes even hours. By then, the tanks have moved. Sensor-to-shooter means the satellite in space sees the threat, uses onboard AI to identify it as hostile, and then automatically feeds that targeting data directly to the weapon system on the ground in seconds.
So you cut out all the middlemen and all the lag time.
Exactly. In modern warfare, speed is survival. CCI now owns crucial pieces of that entire chain. They have the space sensor from RRKA, the data processing from their own AI tech, and the ground link from Azure Summit. That is a very powerful, very integrated offering that very few companies can match.
And financially, this deal looks good on paper.
Very good. It's expected to be accretive to both revenue and earnings immediately. They expect RKA to add about $650 million in revenue and $145 million in EBITDA over the next 12 months alone.
So it's not a fixer-upper project.
Not at all. It's a high-performing, high-margin asset that they are bolting onto their existing business.
However, and there's always a however with deals this big, spending $2.6 billion in cash has consequences for the balance sheet.
This is where the risk creeps into the story. Because of the all-cash RRK deal, their net leverage is expected to rise to about 4.3x EBITDA by March of 2026.
4.3 times leverage. For the uninitiated, is that a red flag? Should investors be worried?
It is definitely flashing yellow. In the defense sector, investors typically like to see leverage somewhere between 2x and 3x. When you get above 4x, you're carrying a significant debt load.
And what's the risk there?
The risk is that if interest rates spike or if cash flow dries up for some unexpected reason, that debt becomes very, very expensive to service. It constricts your flexibility. You have to focus on paying the bank instead of investing in the business.
But they have a plan to fix it.
Yeah, they do. Management has been very clear. They've stated they plan to deleverage back down to the low 3x range within just 6 quarters.
18 months.
18 months. And that brings us full circle back to that massive $710 million in projected free cash flow. They're essentially betting on themselves.
They're betting that their cash generation engine is strong enough to pay down this massive new debt very, very quickly.
Precisely. It is a calculated risk. They are leveraging up to buy these high-growth assets, space, and tech, because they believe those assets will generate the cash needed to pay for themselves, and then some. It really validates their confidence in that operational efficiency we discussed earlier.
You wouldn't do an all-cash deal this size if you didn't believe in your cash flow.
Absolutely not.
Okay, let's zoom out now. We've covered the numbers, the tech, the acquisitions. Now we need to talk about the elephant in the room, or rather the DOGE in the room.
The Department of Government Efficiency.
Right. Everyone in D.C. is freaking out about this. There is a palpable fear that the new administration is going to come in and just slash defense spending across the board. We're seeing proposals for an 8% annual reduction.
Which would be a $357 billion cut over 5 years. A huge number.
A huge number. That's the headline, Pierre. And if you're a company selling aircraft carriers or fighter jets programs that are notorious for cost overruns and delays, you should probably be very worried.
You should be. But if you listen closely to CCI's management, specifically their CFO, Jeff McLaughlin, the reality on the ground for them is very, very different.
He said the disruption from DOGE was, quote, minimal. Right.
He did, and this is where we have to really understand the nuance of defense spending. Not all defense dollars are created equal. When politicians talk about cutting waste, they're usually talking about these massive, decade-long hardware programs that are billions over budget.
Right, the gold-plated tanks narrative.
Yeah.
The hammers that cost $1,000.
Exactly. But CCI isn't selling gold-plated tanks. They're selling intelligence support. They're selling cyber defense. They're selling electronic warfare. These are things you cannot cut without immediately blinding your military.
They're sticky revenues.
Incredibly sticky. If you cut CACI's contract, the lights go out at the National Security Agency, or the drone defense system around a critical base goes offline. That is a risk that no politician, regardless of party, wants to take.
There was also a fascinating semantic shift noted in the sources. The Pentagon is now being referred to as the Department of War.
Yes, that's a return to its original terminology, and it perhaps signals a more aggressive or direct posture from the new administration. It implies a focus on lethality and readiness rather than on bureaucracy and process.
And with that new posture comes a change in buying habits. The sources mention that the secretary is looking to buy commercial solutions.
Buying commercial. This is a phrase that keeps popping up, and it's critical. What it means in practice for a company like CCI is revolutionary.
Explain it. What does that mean?
It means the government wants the 85% solution that is available to buy right now, rather than waiting 10 years for the 100% perfect solution that might never even arrive.
Ah, okay. So instead of paying a giant prime contractor to spend 15 years developing a perfect custom-built radio from scratch, they want to buy the really good radio that CCI already has sitting on the shelf.
That's it exactly. They want commercial off-the-shelf, or COTS, technology. And CCI has been preparing for this moment for years. They have been investing their own money, what the industry calls IRED, or internal research and development, to build these products ahead of government need.
So they took the risk themselves.
They took the risk to build the inventory. So when the new Department of War comes knocking and says, we have a drone problem in the Middle East and we need a jammer now, CACI can say, here it is. It's Merlin. It's battle-hardened. It works. We can ship it to you tomorrow.
CEO John Mengucci had a great quote about this. He said that while other defense CEOs had long faces regarding all these new acquisition reforms, he gave it 2 thumbs up.
Because CCI is agile. They're smaller than the giants like Lockheed or Northrop Grumman. They can pivot faster. So this chaotic environment where efficiency and speed are valued over these massive, slow-moving programs, it actually favors CCI's business model.
So for them, chaos is a ladder.
In this specific case, yes. The disruption of the status quo is a massive opportunity for the challenger, for the more nimble player.
But we have to be fair, and we have to look at the risks. It's not all sunshine and rainbows. What keeps a CCI shareholder awake at night?
Well, the government budget risks are still real. Even if CCI is well-positioned within the budget, an 8% across-the-board cut would hurt everyone. You know, a rising tide lifts all boats, but a draining ocean lowers them all too.
The pie gets smaller.
The pie gets smaller, and the fighting for the remaining scraps gets fiercer. You might even see the big primes coming down market to try and eat CCI's lunch on smaller contracts.
And then there's the perennial issue of continuing resolutions, or CRs.
Right. We touched on this with the backlog. A CR effectively freezes government spending at last year's levels. Critically, it means no new programs can start.
So even if CCI has the perfect product and the government wants to buy it,
They literally cannot write the check for a new contract during a CR. So if Washington gets stuck in a perpetual CR, which has happened before, that impressive growth engine stalls out pretty quickly.
There's also a valuation concern to consider. The stock is up about 38% over the last 52 weeks. It's not exactly cheap. It's trading at a price-to-earnings ratio of roughly 21.4x.
And that's a significant premium. The peer group average is around 15.7x.
So you are paying significantly more for every dollar of CCI's earnings compared to, say, a Leidos or an SAI.
You are. But the bull case, the argument from supporters, is that you should be paying a premium. You're paying for that higher growth, that double-digit revenue growth versus low single-digit for most peers, and you're paying for that valuable technology mix.
The argument being, if CCI really is becoming a tech company, it should trade at a tech multiple, not a services multiple.
That's the whole debate in a nutshell. Tech companies often trade at 25x or 30x earnings, sometimes higher. Service companies trade around 15x. CACI is arguing, with its numbers, that it belongs in that former category now.
The analysts seem to be buying it. CFRA maintained a buy rating, and they raised their price target to $635.
And if you look at the discounted cash flow models, the DCF models mentioned in the Barron source, it gets even more interesting. They ran what they called a very conservative model.
Conservative?
And it yielded a target price of $965 a share.
Wait, a conservative model gets you to $965? The stock is at $611 right now. That implies it's massively undervalued.
That is the power of compounding free cash flow. If, and this is a very big if, that cash flow growth we've been talking about actually persists. If they really hit that $710 million in free cash flow this year and grow it from there, the math says the stock is cheap.
So the market is currently pricing in some skepticism.
A lot of skepticism. Skepticism about whether they can keep up this incredible pace or if that new debt load will weigh them down. If that skepticism clears, the valuation gap closes and the stock runs.
Let's briefly touch on the competition just to round this out. Who are they fighting against day to day?
It's really a two-front war for them. On one side, you have the giants, Lockheed Martin, Northrop Grumman, General Dynamics.
Primes.
The primes. And CACI beats them by being faster and cheaper. A prime is like an aircraft carrier. It's incredibly powerful, but it's very hard to turn. CACI is a speedboat. The primes struggle to do small, fast tech insertion projects. They want to sell $100 billion platforms, not a few $1 million worth of gadgets.
Okay, and the other side of that war?
On the other side, they have the pure-play service providers. Booz, Allen Hamilton, Leidos, SAI.
And how do they beat them?
By having better proprietary technology. Leidos might have the cleared people, but CACI has the Merlin system. CACI has the RRKA space sensors. That intellectual property creates a moat around their business that a pure service provider just doesn't have.
So if the government wants the Merlin system specifically,
they have to go to CCI. They can't just hire a generic contractor to try and bill it because CACI owns the patent and the source code.
it really sounds like they've carved out this incredibly interesting and profitable niche. They're not quite a prime. They're not quite a service provider. They're a national security tech company.
That is the branding they want, and frankly, the numbers are starting to support it. It allows them to attack the entire market from a unique and defensible angle.
Okay, so let's try to synthesize all of this for our listeners. We have a company that has been around since the Cold War, effectively reinventing itself for the age of AI and drone warfare.
Correct. A legacy company acting like a startup.
They're posting record backlog numbers, a $34 billion safety net. They are seeing absolutely explosive growth in free cash flow, up 189% in the last quarter.
And they are successfully navigating a political environment that is, on the surface, hostile to traditional defense spending. They're doing it by positioning themselves as the efficient, commercial, off-the-shelf solution. They are zigging while the rest of the market expects them to zag.
But, but they are leveraging up their balance sheet significantly to do it. They are betting the farm, or at least $2.6 billion of it, on these big space and tech acquisitions.
It is a high-stakes strategy, there's no doubt about it. But so far, the execution has been flawless. It's important to note they aren't just going out and buying revenue to look bigger. They are strategically buying capability gaps. They are buying the future of warfare.
Here is where it gets really interesting for me as an investor. We often think of defense as this big monolith. Just buy defense stocks when the world is scary. But this coverage shows that there are these hidden pockets of hypergrowth right inside the sector. CACI is essentially a tech growth stock wearing a camouflage helmet.
That is a great way to put it. And for you, the listener, the key takeaway is to watch that cash flow. Just watch the cash. If CACI hits that $710 million target in FY26, and if they deleverage that balance sheet as promised, that wild $965 valuation target starts to look less like a dream and more like a distinct probability. The cash flow is the compass that will tell you if the story is on track.
But on the flip side, if those budget cuts are deeper than anyone expects, or if the integration of a massive company like RRKA stumbles,
Then that 4.3x leverage becomes a very heavy anchor very quickly. The margin for error is much smaller now than it was a year ago.
high risk, high reward.
Yeah.
But it is certainly not boring.
No, not boring at all. It's one of the most dynamic and interesting stories in the entire industrial sector right now.
Before we wrap up, I want to leave the listener with a final thought to mull over. We talked a lot about the Pentagon buying commercial, this idea of the 85% solution. If the U.S. government, the largest, most complex, most bureaucratic buyer in the entire world, is truly shifting its entire procurement model to buying good enough right now instead of perfect in 10 years, what does that do to the rest of the defense industry? Does this mark the beginning of the end for the era of the mega prime contractor as we know it? Something to think about.
It is a potential paradigm shift that could completely redefine the entire sector for the next 20 years. A fascinating question.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.